This is our Forex blog for April 26, 2011, and like always, we want to buy the strongest pairs versus the weakest. And in a perfect world and on a perfect day, the daily, weekly, and monthly trend, which is in a little color strip underneath the real-time trend of each pair, we statistically compare every pair to every other one on multiple time frames using multiple different statistical tools. Some of them measure the percentages of them going up or down. Other ones measure the percentages of them above or below a certain moving average. Other ones measure real-time volatility on a bar-by-bar basis. And then when we average these together, you get a much more smooth and accurate reading that, if it's going to stay strong or weak, it, stays green or red. Anything at or above the dotted white line is extreme strength or weakness. Green is strength, red is weakness. And today you can see both the yen and the dollar both had daily, weekly, monthly trend that was down, and both, for the most part, were weak after about 2 o'clock. Coming up to 2 o'clock, the yen was strong and lost its strength here coming up to 2, whereas the dollar had extreme strength. So, if I have my preference and they're both weak, daily, weekly, monthly trends weak, I will choose the one that had the least amount of strength before, just because the odds go up. And you can see this one flipped red a little bit earlier than the dollar. The euro was one of the strongest. Swiss became extremely strong. The Australian is strong. The New Zealand is strong. Alright, so let's look at the strong euro. After 2 o'clock, you want to buy this against the dollar and the yen. And let's look at this right here at 2 o'clock. At 2 o'clock, it double bottoms right at the lower containment band. The longer term trend is up. And you can see with the Trend Intensity Pro that the intensity of the down move has gone less and less, and it didn't break the lows. And usually the lower and above containment bands contain price. That's why we call them containment bands. There will be 1 out of 5 to 1 out of 10 days where the market can go 20 to 50, even 80 pips above there, but it always reverses at some point, or it goes sideways and the bands readjust themselves. It doesn't always come down. You can get into a huge position up there and lose your entire account. So I'm not saying that, but most of the time the market reverts. And when you get a strong currency like the euro dollar that's made a 2-wave pullback, you have a nice move like this, comes down to the Fibonacci profit target level, which is right at the lower containment band. Didn't have off the charts weakness before, and it has even less weakness at the double bottom. Great place to get in to a trend trade. And I'm going to put on the new Tipping Point and Momentum Pro to show how that will improve your odds. FX tipping point, force equals mass times velocity. So the tipping point is the mass of the market. It's percentage of currencies going up or down on any given bar. You want the euro. If you're buying the euro dollar, you want the euro pound to go up, the euro yen, the euro dollar, obviously, euro Swiss, euro Canadian, euro New Zealand, euro Australian. And you want all those pairs to be going up with a lot of intensity. And that's what the FX Momentum Pro does. It measures every pair, all the euro pairs and all the dollar pairs in this instance, against all the other ones. So let's say you, after this, kind of double bottom down here, and when it went down right here, there was a very high percentage of euro pairs going down, dollar pairs getting stronger, and with a lot of intensity. And then it just kind of inched its way up. And on this bar right here, we have a very high percentage euros going up, dollars going down, and with incredible intensity. So if you bought that breakout of this, multi-hour range after a double bottom, do you know whether it's going to continue up or not? Not really, but you do have these tools to let you know whether to stay with the trade or bail with a small win or a small loss. Look, it broke out. Very high percentage of euro pairs are going up, dollar pairs are going down, and they're doing so with 161% of normal volatility for this time. So the force of the market is up. It's very likely to go up over the next bar or two. Now keep in mind, the longer term trend is up, daily, weekly, monthly trends up. However, did just have a big drop down. It could reverse it to hourly. We have the monthly R2 pivot level right here, the half numbers right there. It could stall at those areas where there's likely to be some selling. So look, it exploded up. And again, the downwards momentum kind of stalled. We have upwards momentum now, and boom. Normally I would look to get out of half my trade here, but almost every euro pair is going up, dollar pair is going down, and it's doing so with 3 times greater volatility than normal. This is a freight train. It's not likely, it could stall here and go sideways for a bar or two, which sometimes happens after big up bars or down bars. But typically, within a bar or two, the trend continues. So I'd hold on. All right, made a higher high. Smaller percentage of euro pairs went up and dollar pairs went down, and the upwards momentum kind of died out. So if it kind of went sideways here for a little bit and then went down, I'd get out of half my trade. But this appears like it's going to continue. All right, went sideways again. And a lot of times that happens. Traders want to digest the move. If it goes sideways for a few bars and breaks out again, everybody who's a professional trader jumps on board that because it's a low risk, high winning percentage type of trade, especially after a momentum move. The stats are on your side. This is a freight train, it's likely to continue. All right, still sideways. That's still in my entire trade, and it's starting to inch its way up here. Tipping point is up. Not a very high percentage of euro pairs went up and dollar pairs went down, but the ones that did so with greater than average intensity. Yeah, if a very high percentage go up and you see a lot of momentum, then each one has average momentum. But if a small percentage of them go up with really close to the one level, the pairs that did move up moved up a decent amount for this time of the day. All right, I'd get out of half my trade here because you don't know if it's going to have a move up to the hourly and stall. Decent percentage of euro pairs are going down, dollar pairs are going up. Decent momentum to the downside. And what I always do when I get into a trade like this, put stop underneath the bars consolidating before it. I might move my stop underneath the monthly R2. Once a resistance level gets broken, it becomes support. So, we're not going to give back more than, 25 to 50% max of the profit we're in. And you can always get back in again, too. All right, pulled back. Lesser percentage went down with almost no momentum to the downside. All right, we got stopped out. Now, but because of that extreme strength on the way up, if this starts to break out again, we're going to buy it again. But we got into this trade around 30, out at half at 60, the other half maybe at 55. If it goes above these bars high right here, 67, we're going to buy it again. Now, preferably it goes sideways for a few bars and the downwards percentages and momentum is low. Look, this bar here, less downwards pressure. Decent percentage of euro pairs going down, dollar pairs getting stronger, but with almost no intensity. So I might, if I really believed in this trade, buy the breakout of this bar's high right here around 60. And if momentum comes in, I stay in it, and if not, I get out with a very tiny loss or break even in many cases. All right. Again, I prefer a pullback and then a little bit of sideways action, and then when it goes up, your odds go through the roof. All right, boom, we're in, and look, high, high, high. Almost every euro pair is going up, dollar pair is going down. 180% volatility. It's very likely to go above the high here, but you always want to draw the fib on the first wave up, and then you look to see the momentum when it hits the fib target. If it's not that much momentum, you get out at the fib target. If there's a lot of momentum, you hold on for the second fib target. Boom, exploded up. Even a higher percentage going up with more volatility. So sometimes after a move, pullback, move, it might go sideways for a bar or two, but we'll see. It's 50-50 whether it goes up on the next bar, but within the next 2 or 3 bars, it's pretty likely to go up. All right, slightly up. Again, after a big move, a lot of times at the end of moves, you see the volatility and the force spike. Your fib target's right up here. We have the whole number. I'd get out of half of it right here near the whole number because the fib target's only 4 pips above there, and then I'd move my stop underneath maybe around 85 on the second half. I don't like to give back maybe more than a third, no more than half ever. So we're in this trade around, let's just say 60. We made 40 pips on half. We're going to make 25 in the second half if we get stopped out, if it doesn't continue. All right, it's continuing up. We're at the upper containment bands. Decent force, of the market. Decent percentage going up. Dollar pairs going down every bar, and okay momentum. It is at a potential reversal area here. And at that point, I'm going to move my stop up underneath here around 94 maybe. And I get stopped out right here. Now I'm not going to buy right at the highs unless it goes sideways for another couple bars. And I'd miss out on that move, but how much did it move? 15 pips. That does suck, but if you just start trading at that time and you're going to use our tick charts to scalp, a lot of times buying the highs you can take out 5 to 15 pips, but if you're using the 5-minute charts and trying to get 30 pip moves, it's better to see an hour and a half sideways move before you buy the highs. So unfortunately, I would have missed that move. If you did buy that move right here, let's just say you did, I wouldn't have done it because it's just not my style. But once you're in that trade, guess what? Decent participation, high volatility. We're at the second fib target. We're at our trading zone, likely reversal area. Momentum is kind of slowing up. If you're in this trade here at 07, it's up at 25 now. That's a decent profit for a relatively higher risk trade. There's some trades that work, but they're still high risk because they don't work, maybe more than 50-50. Let's look at the euro yen with the same tools. Actually, let's put the euro dollar back on, and I'll just change the chart to euro yen here. Again, earlier today at the bottom, we had a double bottom right at the lower containment band, and it came down, went up, came down, didn't break these lows. You buy the breakout of here. And you never know whether a trade will work in the past, but now you do have, you never know if a trade's going to work with our new tools. But if you get in and you see these things spike, guess what? Your odds of the trade working, in my opinion I say, because we're regulated, you're not, in the hands of a less experienced trader, maybe these tools aren't going to work for you, but for me, I find them invaluable. If I bought that breakout right here, decent percentage going up without that much volatility. So my stop underneath here, at this point, it's still a 50-50 trade. Again, lower participation, but a little bit higher momentum for the pairs that went up. They went up, a decent amount, considering a small percentage here. Boom. Very high percentage going up with decent volatility. This trade should work. So I'm moving my stop up right underneath here. I'm going to risk 7-8 pips right now. Boom. Exploded up. Very high percentage and almost 225% volatility. The previous day's low in the hourly right here. So this is where I'm looking to get out. Somewhere between 119, the whole number, and 119.16. Unless it continues with this kind of momentum, it'll explode through those resistance areas. Alright, it kind of stalled out. We're the whole number right here. If this is the first trade of the day I took, I'd probably get out of half of it, be honest with you, with 25 pips. Because I don't want to, I like to start the day with a bang. If I'm up 20, 30 pips already, I might hold on for the next bar. It is kind of losing momentum. More bars went down than up, even though more currencies, more higher percentage went up in the euro and down in the yen, but the ones that did move down with more intensity. So sometimes you get conflicting signals. I would tighten my stop on this because you can always buy it again. All right, it exploded up, and normally I'd get out of the trade right here at the hourly, but almost every euro pair is going up, yen pair is going down with very high volatility. It's likely to shoot through there. I'm going to move my stop up because I'm not going to give, I'm going to put it right below the previous day's low, which is a great resistance area. I mean, it was a resistance area, it becomes support. Yeah, it's debatable whether we got stopped out here. And there we did. And notice on this move down here, not too high a percentage of euro pairs going down, yen pairs getting stronger, and with very low volatility. So if it breaks above, this high right here, I'm going to jump right back in. And I prefer it to go sideways another 2 or 3 5-minute bars minimum. All right, we got a pullback, decent weakness, so I'm going to wait a little bit before buying. I'm not buying this next bar because of the weakness before. All right, now it broke out with a lot of intensity. If you see that in real time and you're able, to get into it a little bit earlier than this, you would. If it goes above this high, we're going to have to buy. Now, I hate to buy 20, 25 pips above the swing low. Absolutely hate it. But with this tool, at least in real time, within 5 minutes, whether the trade's likely to work. So I've broken, I've changed that changed that methodology for myself. If it goes above this high, I'm in. But if it doesn't take off, I'm going to get out because it's a very risky thing to do. All right, I'm in. My stop now, I'd have to trade less lots on this because my stop initially is larger. But I'm moving my stop up, and it better go up on the next bar or two. I'm going to just take a small profit. All right, I'm going to move my stop, to break even now. And it's going sideways. Knowing myself and my lack of patience, I would have got out of half my trade somewhere around 35 here for about 12 to 14 pips in the first half. And it looks like a decent percentage of them are going down. I'm out of this trade just because it was a risky trade. It's likely to pull back, and if it doesn't go underneath the hourly or the previous day's low, I'm going to buy it again. I don't have any problem taking a trade, especially riskier ones, and then getting out pretty quick. And this might shoot up without me. If it goes sideways another 2 bars, I'd buy the breakout here. I'd much prefer a pullback. Alright, so there we go, 2 bars. It's gone sideways long enough. If it does break out, it's likely to continue because there is no sellers enough to drive down price. And the volatility in the down bars is not much. Big volatility up, low volatility down, that makes a good breakout. So I'm going to jump the gun here and get in a little bit early because I want a tighter stop, and that allows me to trade more lots. My risk is less than 10 pips on this, and if it doesn't break out in the next 2 bars, I'm out. All right, I made a higher high, decent participation. Actually, that was the previous bar. Sorry. All right, we got stopped out on that one. That one lost. Like I said, riskier trades tend to work 50-50. But at least when this broke out, notice there was no tipping point up here, and the net effect of all the pairs was slightly down. Because of this strong momentum before, I still would have hung in for another bar. I'd rather take a 8 or 10 pip loss with the chance of making 20-30 pips, especially after taking quite a few other very profitable trades. These are small losses, bigger wins. That's the key to trading. There's nothing complicated about it. Now the Swiss, very strong today. We saw especially from 2 to 5, and then afterwards from 2 to 5, this one was very strong. So the dollar Swiss would have been an excellent one to short from 2 to 5. Let's look at that one real quick to end the daily blog here. Now initially, price is above the hourly. It's always better to short when it's underneath it. It pulled back, the longer term trend's down. If you see it pull back with a lot of weakness, go sideways, it's very likely to break the hourly. So if the longer term trend's down, every once in a while I'll break my rule and get short a little bit early. Let's scroll over to see what this looks like bar by bar. Alright, decent participation down, decent weakness. In fact, I probably wouldn't have taken that trade after the extreme strength on the previous bar. So I'm going to wait and see what happens here at the hourly. If it goes sideways here for a bar or two, I'm going to go short. Alright, I'll be short right there with my stop right above the high. And not a whole lot of participation down. Okay, momentum. Alright, now it goes. High percentage of dollar pairs going down, Swiss pairs going up with decent momentum. And we have this first wave down, which will give us our fib targets. And most of the time, unless the momentum is off the charts, that's where I'm going to get out at least half the trade. Alright, shot down. And notice, again, off the charts momentum. Almost every dollar pair is going down. Every Swiss pair is going up with 221% volatility. It came down and hit this fib target right here. I have to get out of half the trade here just because the majority of the time, 60 to 70% in my experience, the markets may go a few pips beyond that, but then they reverse. So I have to get out of half at 87. I'm short at 10, 23 pips minus the spread. And I'm going to move my stop down right above the whole number here. It should stay underneath there if the trend's going to go down. Alright, it's losing momentum. And there it goes. It's at the lower containment band. I'll wait and see what happens on the next bar, but I'm probably going to get out of here at 76. Alright, I'm out right here. Because usually at the lower containment band, previous day's low, even with this kind of momentum, it's likely to get some kind of a bounce. And it really doesn't, but that's where I would have got out. Who cares if you don't catch every move? The point is to have bigger wins and losses and feel comfortable, pulling the trigger. And I find certain trades make me very uncomfortable. Selling the low without seeing it go sideways at least 30 minutes to an hour, hour and a half, it makes me extremely uncomfortable. So I may, over time, because these tools, I think, increase my odds dramatically, break that rule, but haven't yet adapted that yet.